Look, I need you to pay very close attention to what I'm about to tell you because what's happening right now in the gold market isn't just unusual, it's unprecedented. And if you own physical gold or you've been thinking about buying some, the next few minutes could be the difference between protecting your wealth and watching it evaporate. I'm going to show you something that most people have no idea is happening, something that the mainstream financial media either doesn't understand or doesn't want you to know about, and I'm going to prove it to you with hard data, not theories or speculation. Here's what's going on. Gold just surged past $4,000 an ounce for the first time in history. That's a 56% gain in a single year. Silver has doubled. These aren't normal moves. These are the kind of price explosions that happen when something fundamental breaks in the financial system. But here's where it gets interesting. While gold is hitting all-time highs, something else is happening that should terrify anyone holding paper assets. The COMEX, which is the largest gold futures exchange in the world, is experiencing something that traders call a delivery squeeze. What does that mean? It means people are demanding physical gold, and the exchange is struggling to deliver it. Let me explain why this matters. The COMEX operates on a fractional reserve system. For every ounce of physical gold in their vaults, they've sold claims to that same ounce multiple times over. It's like a bank that only keeps 10% of deposits on hand, assuming not everyone will withdraw at once. But what happens when everyone shows up demanding their gold at the same time? That's what's starting to happen right now, and the implications are staggering. You see, the gold market has been manipulated for decades through paper contracts. Banks and institutions have been able to suppress the price by flooding the market with paper gold, futures contracts that represent gold but aren't actually backed by physical metal. It's a shell game, and it's worked beautifully. Until now. Central banks around the world are buying physical gold at the fastest pace in recorded history. China, Russia, India, Turkey, Poland, they're all accumulating. In fact, central bank purchases have been running at over 1,000 tons per year. That's not a small number. That's a coordinated move away from dollar-denominated assets. Why would central banks be doing this? Because they see what's coming. They understand that the dollar's dominance as the world's reserve currency is ending. Not tomorrow, not next week, but the process has already begun. And when that shift accelerates, the price of gold isn't going to 4,000 or 5,000. It's going to levels that seem impossible right now. But here's the danger I mentioned. If you own physical gold, you need to understand that what you're holding is becoming increasingly valuable, not just in dollar terms, but in terms of what it represents. Physical gold is real money. It's the only form of money that can't be printed, debased, or inflated away. And as more people wake up to this reality, the scramble for physical metal is going to intensify. The problem is most people who think they own gold don't actually own gold. They own paper promises. ETFs, mining stocks, futures contracts, these are all derivatives of gold. They're not the real thing. And when the system comes under stress, those paper claims are going to be worth a fraction of what people think they're worth. Let me give you a specific example. The largest gold ETF in the world holds about 25 million ounces of gold. Sounds like a lot, right? But here's the thing. The total amount of paper gold claims outstanding, all the futures contracts, all the unallocated gold accounts, all the ETF shares represents over 100 times more gold than actually exists in physical form. 100 times. What happens when people start demanding delivery? What happens when investors realize that their paper gold can't be converted to physical metal? The price of physical gold is going to decouple from the paper price. We're already seeing early signs of this. Physical gold is trading at premiums to the spot price in certain markets. Dealers are running low on inventory. Delivery times are stretching out. This is the serious danger. Not that gold is going to crash. The danger is that if you don't own physical gold, you're going to be left holding worthless paper when the music stops. Now, I know what some of you are thinking. This sounds extreme. This sounds like fear-mongering. But let me show you the evidence. Basel III regulations, which went into effect recently, changed how banks have to account for gold on their balance sheets. For the first time, physical gold is now classified as a Tier 1 asset, the same as cash. Unallocated gold, paper gold, is not. Do you understand what that means? The global banking system just officially recognized that physical gold is money, and paper gold is not. Banks are now incentivized to hold physical gold instead of paper claims. This is creating a structural shift in the market. Institutions that used to be happy trading paper are now demanding physical delivery. and there isn't enough physical gold to satisfy that demand at current prices. The London Bullion Market Association, the LBMA, which is the center of the global gold market, has been quietly draining. Vaults that used to hold thousands of tons are seeing outflows. Where's that gold going? It's going east. It's going to China, to India, to the Middle East. It's leaving the Western banking system and moving into strong hands that aren't going to sell it back. This is a one-way flow, and once that gold leaves London and New York, it's not coming back. The West is losing control of the physical gold market, and most people have no idea it's happening. Here's another piece of the puzzle. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been compressing. It's currently around 75 to 1. Historically, that ratio has been much lower. In the ground, silver and gold are mined at a ratio of about 8 to 1. Throughout most of history, the monetary ratio was 15 to 1. What does this tell us? It tells us that silver is massively undervalued relative to gold, and when gold makes its next major move higher, silver is going to explode. We're talking about potential moves of 200, 300% in a short period of time. Silver is the most volatile precious metal, and it amplifies gold's moves in both directions. But here's why this matters for gold owners. The silver market is even smaller and more manipulated than gold. There's less above-ground silver available than gold. Industrial demand for silver is massive and growing, especially with the green energy transition. Solar panels, electric vehicles, electronics, they all require silver. And unlike gold, silver gets consumed. It doesn't get recycled at the same rate. When the silver market breaks, and it will, it's going to send a shockwave through the entire precious metals complex. It's going to expose the paper manipulation in gold. It's going to force the issue of physical delivery. And it's going to accelerate the move into physical precious metals. Now, if you're sitting on retirement accounts, IRAs, 401ks, and you're watching this unfold, you might be wondering how you can protect yourself. Quick aside here, if you've got $100,000 or more in retirement savings, I put together a free guide on how gold IRAs actually work. It's in the description below. It covers how you can get physical gold into your retirement account without triggering taxes or penalties. Worth checking out if that's relevant to your situation. Anyway, back to what's happening in the market right now. The Federal Reserve is in an impossible position. Inflation is still running hot, despite what the official numbers say. Anyone who buys groceries or pays rent knows the real inflation rate is much higher than the reported figures. But the Fed can't raise interest rates much more without breaking something in the financial system. We've already seen bank failures, stress in the commercial real estate market, and mounting losses on Treasury holdings. So what are they going to do? They're going to pivot. They're going to start cutting rates and expanding the money supply again. They have no choice. The debt burden is too large, the deficits are too big, and the political pressure is too intense. And when they do, gold is going to go parabolic. Think about what happened in the 1970s. Gold went from $35 an ounce to over $800 in less than a decade. That's a 22 times increase. But here's what most people don't realize. The real move happened in the last 2 years of that bull market. Gold went from $200 to $800 in just 18 months. We're setting up for a similar move right now. All the conditions are in place. Massive government debt, currency debasement, geopolitical instability, loss of confidence in institutions, and a structural shortage of physical gold. The only question is timing. But here's the thing about timing. You can't time the top of a bull market. Nobody rings a bell. By the time it's obvious to everyone that gold is the place to be, the big gains will already be made. The smart money is positioning now, while most people are still skeptical. Look at what happened in 2008 during the financial crisis. Gold initially sold off with everything else as investors scrambled for cash, but within months, it was making new highs while stocks were still in free fall. Gold went from $700 to $1,900 over the next 3 years. The people who bought during the panic made life-changing returns. We're in a similar setup now, except the fundamentals are even more extreme. The debt levels are higher, the money printing is larger, and the geopolitical tensions are worse. The next crisis, whenever it comes, is going to make 2008 look like a warm-up. And here's what you need to understand about owning physical gold during a crisis. It's not just about making money. It's about having a form of wealth that can't be confiscated, frozen, or devalued by government decree. It's about having an insurance policy that's been recognized as money for 5,000 years. When banks close, when ATMs don't work, When electronic payment systems go down, gold still has value. It's always had value. It always will have value. That's not speculation. That's historical fact. But the danger I'm warning you about is this. If you wait until the crisis is obvious, you won't be able to get physical gold. Dealers will be sold out. Premiums will be astronomical. Delivery times will be measured in months, not days. You'll be forced to pay panic prices, if you can get it at all. This is already starting to happen in certain markets. In India, physical gold is trading at significant premiums to the international spot price. In China, there are reports of shortages at retail dealers. In the United States, some products are on back order. These are early warning signs. The smart move is to position yourself before the crowd figures it out, not with paper gold, not with mining stocks, but with physical metal that you can hold in your hand or store in a secure vault under your control. Now, let me address something that skeptics always bring up. They say gold doesn't pay interest or dividends. It just sits there. That's true. But that's also the point. Gold is money, not an investment. It's a store of value, not a yield-generating asset. When you own gold, you're opting out of the financial system's promises and holding something real. Think about it this way. If you own a bond, you're lending money to a government or corporation in exchange for interest payments. But what's the risk? The risk is that the borrower defaults, or that inflation erodes the value of your principal, or that interest rates rise and your bond loses value. You're taking on counterparty risk. If you own stocks, you're buying a piece of a company. But what's the risk? The risk is that the company performs poorly, that management makes bad decisions, that the economy enters a recession, that the market crashes. You're taking on business risk and market risk. If you own real estate, you're buying property. But what's the risk? The risk is that property values decline, that you can't find tenants, that taxes and maintenance costs eat into your returns, that you're forced to sell at the wrong time. You're taking on illiquidity risk and market risk. But if you own physical gold, what's the risk? The only risk is that the price goes down in dollar terms. But gold itself doesn't go away. It doesn't default. It doesn't go bankrupt. It doesn't require maintenance. It's just there, holding its value over time. And here's the key insight. Over long periods of time, gold maintains its purchasing power. An ounce of gold today buys roughly the same amount of goods and services that it did 100 years ago. Can you say the same about the dollar? A dollar today buys a fraction of what it bought 100 years ago. That's the difference between real money and fiat currency. So when people say gold doesn't pay interest, the response is, it doesn't need to. Gold is protecting you from the loss of purchasing power that comes from holding depreciating currency. That's its function. That's its value. Now, let's talk about what's happening with industrial demand for gold. This is a part of the story that doesn't get enough attention. Gold isn't just a monetary metal anymore. It's increasingly being used in technology. Electronics, medical devices, aerospace applications, they all use gold because of its unique properties. It doesn't corrode, it conducts electricity perfectly, and it's incredibly malleable. As technology advances, industrial demand for gold is growing. And unlike silver, where industrial demand is a huge part of the market, gold's industrial demand is still relatively small compared to investment and jewelry demand. But it's growing, and every ounce that goes into industrial use is an ounce that's not available for investment. This creates a supply squeeze. Gold mining production has been flat to declining for years. The easy gold has already been mined. New discoveries are rare. Existing mines are getting deeper and more expensive to operate, and it takes 7 to 10 years to bring a new mine into production. So we have declining supply, increasing industrial demand, massive central bank buying, and growing investment demand from individuals who are waking up to the reality of currency debasement. What do you think happens to the price? It goes up. It has to go up. There's no other mathematical outcome. But here's where the danger comes in for people who own gold. As the price rises, governments are going to start paying attention. They're going to start asking questions about who owns gold, how much they own, and where it's stored. History shows us that when governments get desperate for revenue, they go after gold. In 1933, the U.S. government confiscated gold from its citizens through Executive Order 6102. They forced people to turn in their gold at $20.67 per ounce, and then immediately revalued it to $35 per ounce. That was a 40% devaluation of the dollar overnight, and the government captured all the gains. Could that happen again? Legally, yes. The government has the authority to confiscate gold during a national emergency. Practically, it would be much harder to enforce today because gold ownership is more widespread and less centralized. But the point is, it's a risk that gold owners need to be aware of. This is why how you own gold matters. If you own gold through an ETF, the government knows exactly how much you own. If you own gold in a bank safety deposit box, the government can access it. If you own gold in your home, you have more privacy, but you also have security risks. The optimal strategy is to own physical gold in a secure, private vault outside the banking system, or to own it through a structure that provides legal protection. This is something that high-net-worth individuals and family offices have been doing for years. They're not keeping their gold in bank vaults. They're keeping it in private vaults in jurisdictions with strong property rights. Now, I want to talk about what's happening with the BRICS nations, because this is a huge part of the gold story that most people are missing. BRICS stands for Brazil, Russia, India, China, and South Africa, but the group has been expanding to include other nations. These countries represent about 40% of the world's population and a growing share of global GDP, and they're all accumulating gold. Why? Because they're building an alternative to the dollar-based financial system. They're creating new payment systems, new trade agreements, and new currency arrangements that bypass the dollar. And gold is the foundation of this new system. China has been particularly aggressive. Official numbers show they've been adding to their gold reserves consistently, but many analysts believe their actual holdings are much higher than reported. China has been importing thousands of tons of gold through Hong Kong and Shanghai. Where's all that gold going? It's going into official reserves, into sovereign wealth funds, and into the hands of Chinese citizens who are encouraged to own gold as a form of savings. Russia has been doing the same thing. After being hit with sanctions, Russia accelerated its gold buying and reduced its dollar holdings. They've been mining gold domestically and buying it on the international market. Gold now makes up a significant portion of Russia's foreign reserves. India has always had a cultural affinity for gold, but now the government is also accumulating. The Reserve Bank of India has been a consistent buyer, and Indian citizens buy more gold jewelry and coins than almost any other country. What does this tell us? It tells us that the largest and fastest growing economies in the world are moving away from the dollar and into gold. This is a tectonic shift in the global financial system, and it's happening right now while most Americans are completely unaware. When the dollar loses its reserve currency status, and it will eventually, the implications for Americans are profound. It means higher inflation, lower living standards, and a massive repricing of assets. Gold, priced in dollars, is going to go much, much higher. But here's the thing. This isn't going to happen overnight. It's a process that unfolds over years and decades. But the trend is clear. The dollar's dominance is ending, and the smart money is positioning for what comes next. So what should you do if you own gold? First, make sure you own physical gold, not paper promises. Second, make sure it's stored securely, either in your possession or in a private vault. Third, don't sell it. This is a long-term hold. You're not trading gold, you're preserving wealth across generations. And if you don't own gold yet, the question you need to ask yourself is, what are you waiting for? Are you waiting for the price to go higher so you can feel validated? Are you waiting for a crisis to make it obvious? Are you waiting for permission from some financial advisor who's incentivized to keep you in stocks and bonds? The time to buy insurance is before you need it. The time to position yourself for a monetary reset is before it happens. The time to own gold is now, while it's still available at reasonable prices. Look, I'm not telling you to put your entire net worth into gold. That would be foolish. But having 10 to 20% of your liquid assets in physical precious metals is just common sense. It's a hedge against all the things that could go wrong. Currency collapse, banking crisis, geopolitical conflict, government overreach, these are all real risks. And gold protects you from all of them. The danger I'm warning you about isn't that gold is going to crash. The danger is that you're going to wake up one day and realize that the window to buy physical gold at reasonable prices has closed, that the dealers are sold out, that premiums are through the roof, that delivery times are measured in months, that the government has imposed restrictions on gold ownership or transactions. These things have happened before in history. They can happen again, and when they do, it's too late to act. So take this seriously. Do your own research. Look at the data. Look at what central banks are doing. Look at what the smart money is doing, and then make a decision based on facts, not emotions or mainstream narratives. Because what's happening in the gold market right now isn't normal. It's a warning sign. It's a signal that something big is coming. And the people who are paying attention, the people who are taking action, are going to be the ones who preserve their wealth through whatever comes next. The choice is yours. You can ignore this information and hope everything works out. Or you can take responsibility for protecting your financial future. But don't say you weren't warned. The signs are everywhere. The data is clear. And the clock is ticking.